Hello. In this investor's overview, we look at how the way of the money has changed. This is important for you if you want to choose an investment that will give you a positive return. Let's start with a global perspective. The good news is that although there may be bumps in the road in 2022 and, as I mentioned in previous investors' overviews, high inflation is here to stay, analysts do not expect a recession. 2023 could be a question in this respect, as it will depend largely on how and what central banks do to tackle inflation. Let's look at what you can see at shares. As you may have seen earlier, almost simultaneously with the emergence of the COVID, many countries have started to push large amounts of money into the economy to recover it. The low cost of funding, the promise of endless money, and the difficulty of spending it in the physical world because of the quarantine, sent almost all stock prices skyrocketing. But this trend seems to be reversing. The US Federal Reserve has started to cool the economy because of high inflation. The effect of the interest rate hike has been to reduce the amount of cash in the economy and to increase the interest rate on loans. These two in turn have an impact on the stock market. This is not surprising, because if you have a lot of cash, you can only spend part of it, even if it is for external reasons. You seek a place for the rest elsewhere. Obviously, you want to find a place where you can earn a lot. If this much money is not only available to you, but also to many other people has a lot of reserves, then many people will invest in shares, which will push up the share price. The effect of this, combined with a low borrowing rate, is more pronounced. This has been the case so far, as the share price has also been able to rocket because many people have bought shares with leverage, so with credit. The credit-funded leverage positions are now falling and this is pulling the share price down. You can see this in the chart of the S&P 500 stock index. Of course, this doesn't mean that they will cease to exist, just that patterns are changing. Whereas growth stocks used to be the star performers, now value-based investments are doing better. Also, stocks of companies that can perform well in the current environment are showing growth. At shares, it may serve you well to pay attention to volatility. Indeed, high volatility that appears typically shows increased movement. This is measured by the VIX. The breakout points are usually a long-term entry point for you. The other change is territorial reallocation. U.S. indices have performed poorly this year, thanks to the tightening of fiscal and monetary policy. The quarantine due to the emergence of a new wave of COVID in the Far East and China's shift in focus from quantitative growth to social catch-up also hit indices there badly. However, these previously lagged behind were a good entry point. One example is the Turkish index. Next, let's look at what you can see if you take the dollar itself as the basis for investment. Many countries are either indebted in dollars or pay for imported goods, energy and raw materials in dollars. This is why one of the most important indices is the dollar index, where the dollar is not measured against the currency of a specific country, but against a basket of currencies. The dollar index tells you whether the dollar is strengthening or weakening against the currencies of other countries. As you can see in the picture, this index is at its highest level in the last 1 year. And it is not just the top of 1 year, but of a much longer time frame. If the countries that performing in dollar don't move, it could have a significant impact on their economies, and in a negative direction. After all, they get the same thing more expensively. If you are investing or have invested in these areas, you can expect them to face difficulties. This is also true on a larger scale. Not just for individual smaller countries, but for the European Union as a whole. While the Fed has long since begun monetary tightening, now joined by fiscal, so the government-led tools, the European Central Bank is still on hold and has not yet taken any meaningful action against inflation. There have been interest rate rises of around 0.5%, but there is apparently no balance between a minimum inflation rate of around 8% and a 0.5% rate rise. This increase is not expected to suck large amounts of cash back into the economy. Therefore, the euro has weakened against the dollar, which could have a negative impact on the economy of the European Union as a whole. Now that we've looked at the weaker performance of stocks, let's look at what is rising. This is none other than raw materials. In the current economic environment, commodities have shown one of the biggest increases. You could think of high oil prices, which is expected to stay with us for a while, or you could think of agricultural products. Indeed, due to events in Ukraine, wheat prices, for example, are expected to double compared to last year. So whether you invested in these products directly or indirectly through indices, you could have made a nice return, and this level of return is expected to stay with us for a while. Of course, with commodities, the right selection is also paramount. Although gold is involved in industrial production, its price is much more influenced by its presence as an escape asset. Although the fear of the outbreak of war was reflected in the price of gold, fortunately the war remained local and so prices calmed down. As you've seen for yourself, there are a few hazards to watch out for. Interestingly, these have not changed from those mentioned in last October's overview. Then, as now, there is still the presence of a rebalancing and potential liquidity problem due to the closing of the money taps. The geopolitical risk is still there, only this time it is not because of Afghanistan but because of the Russian-Ukrainian war. Also still with us is the emergence of a new mutation of the COVID, or the threat of another quarantine due to the old ones. Also has not changed the price-wage spiral pressures that are making life difficult for companies. The threat of stagflation is also still present, which fortunately is still only a possibility and the statistics are good. What is less good news is that we still have the problem of high inflation. Since we've talked so much about inflation, let's look at what you can do to defend your money. Investment options in different asset classes perform well in different market environments. Currently, high inflation means that interest-earning options are performing poorly. This means that in real terms, so in terms of changes in purchasing power, they will almost certainly cause you to make a loss. Examples include corporate bonds, government bonds, and even bank deposits. You can achieve a positive result with investments that give you some kind of yield. Be sure to choose investments where there is a broad demand and where the increased costs can therefore be built into the price. Examples include equities and real estate. As we are in a bumpy period due to market events, the right choice cannot be overemphasized. On the one hand, it should be appropriate for the market, so it should have growth potential, and it should also be appropriate for you. In other words, it should also fit your risk-bearing capacity and the time horizon you have chosen. This is not easy in the current environment, so if you need help, our private bankers can help you. To contact us, you can find a link in the description. As a closing, let's take a look at what you can see in Hungary. Currently, Hungary is considered a risky area for foreign investors because of its proximity to the war. Although there are good investment opportunities in this region, for example in equities, the emerging risk has scared off too many foreign investors to allow prices to move up. Further risk is that the financial and energy sectors are likely to be subject to additional taxes. In the case of domestic blue chips, the import connection or even affiliate relationship that existed before the war in Ukraine is an additional risk, as these branches are not currently making profits. As Hungary has not yet reached an agreement with the European Union, the funds from the Union have not yet arrived. As this is a significant amount in GDP terms, it is unlikely that the Hungarian state will be able to finance it for a long time. Presumably, the end of this is an agreement as soon as possible, otherwise the state will have to continue to bear the burden of this deficit on the public and businesses, including you, who live or may just consume in this country. Hungarian inflation is expected to remain high, as the vast majority of inflation in Hungary is driven by imported inflation. The Hungarian central bank is finding it difficult to maintain the stability of the forint, which is why you are currently seeing all-time highs, so be prepared for the trend to continue to strengthen. To avoid this, either do not hold significant amounts of forint, say because you are investing it, or choose an investment that outperforms on a forint basis.